like to introduce today's presenting sponsor, and it's North County Area President, Wells Fargo, Brian Lee. Would you please join us now? Oh, there you are.
So good morning, everyone. On behalf of the 3,200 Wells Fargo team members that live in San Diego County, Wells Fargo is proud to support the San Diego North Economic Development Council and to be the presenting sponsor of the second annual Economic Summit. As this important event focuses on our North San Diego communities and economy, we are proud to partner with the San Diego North EDC in continuing to make this an important annual event in our North County region. Now, I have the privilege of introducing one of our featured guests this morning and our first presenter. Mark Vittner is Managing Director and Senior Economist at Wells Fargo, responsible for tracking United States and California economic trends. Mark is a 22-year company veteran and is based in Charlotte, North Carolina. Mark writes for the company's monthly Economic Outlook report, the weekly economic and financial commentary, and provides regular updates on the housing markets, commercial real estate, region economies, and inflation. Mark's commentary has been featured in the New York Times, Wall Street Journal, Bloomberg, and many other national publications. Mark is a member of a number of national associations, including serving as the chair of the Economic Advisory Council for the California Chamber of Commerce. Please join me in welcoming Wells Fargo's senior economist, Mark Vittner.
Good morning. It's great to be back. I remember last year, and last year I still think we had some folks that were doubting as to whether or not the real recovery was here. And a year later, it's certainly clear that things have picked up a notch. And we've seen that not only has growth been stronger, but it's been much more broadly based than we saw earlier in the recovery. What I'm going to do is real quickly go through the U.S. outlook, and I've got a series of 5 questions that I get asked quite a bit, and go through and provide some quick answers on that, run through some slides, and then talk a little bit more about California and what's going on to the state, and then we're going to hand it off and get into the down to the local area. In terms of the overall economy, I think the number one question on people's minds, and I imagine a lot of people that turned on CNBC are probably asking the question this morning, because I think the stocks are down 200 points, saying, well, how much of last year's strong momentum is going to carry over into 2015? And in terms of strong momentum, last year GDP growth was 2.4%, which was not a blowout number, but it was much stronger than that toward the middle of the year. And toward the end of the year, we had the plunge in oil prices, and that drop in oil prices cut into growth late last year. If you look at final demand from consumers and businesses, it was about 3%. In terms of employment, we added about 1 million jobs in the last 3 months of last year, and the strong job growth has carried over. We've got 2 months of data into 2015. We added 295,000 jobs in February, about 240,000 in January. So it's not just the number of jobs. Early on, a disproportionate share of the jobs that we were adding were in lower paying industries, and they tended to be part-time. And even today, after 5.5 years, almost 6 years of economic recovery, we still have slightly fewer full-time jobs in the U.S. economy today than we did before the recession began. There's 900,000 fewer people working full-time today than there were prior to the recession. But a year ago at this time, it was like 2.1 million. So we've made a lot of progress on that front in the last year. In terms of how much of the momentum is going to carry over this year, we're looking for GDP growth to be about 2.8%. And job growth, which has been running somewhere between 250,000 and 300,000 a month over the last 6 to 9 months, we think that's going to slow, but the quality of jobs that are going to be added will be better. So there'll be more higher paying jobs, more full-time jobs, but probably a smaller net number of new jobs added on a monthly basis this year. Second big question we get has to do with oil prices. And, they fell so rapidly last year, and so much of what we heard about oil prices, I think was so far off the mark. When oil prices started to fall, I remember I was visiting Tyler, Texas. It's in East Texas. And oil prices had just recently broken below $90 a barrel. And someone asked me the question, where do I think oil prices are going to bottom? And I said, well, they're going to go below 50. And the whole room just stopped. They said, nobody's thinking they would go below 50 because the break-even cost of producing oil in the Bakken is $70 a barrel. And I thought, what world are you living in? I mean, when a product is oversupplied, the price doesn't just drop to the break-even level so everybody can go home and be happy. I mean, I think that's what happens when everybody gets a trophy. I mean, they think that everybody's going to be fine. That's not what happens. The price drops to the marginal cost of the most efficient producer. And the marginal cost of getting oil out of the Bakken is well under $20 a barrel. It's $20 a barrel in the Canadian tar sands. So the price of oil can drop considerably. I don't know that it'll get to 20, but we haven't seen the lows yet. And oil production in the U.S. hasn't slowed at all. The other misconception that we've had is people were wondering whether it is a supply-driven problem or a demand-driven problem. And global demand has been weak. There's no question about that. But global GDP growth was stronger in 2014 than it was in 2013. So demand didn't weaken. That's not where, in economics, everything happens at the margin. What happened was U.S. production increased tremendously. We've accounted for all of the growth in global economic and global oil output. And what producers are doing now is they're shutting down their least efficient wells, concentrating their resources on their most efficient wells. And we're going from producing 1.5 million barrels more per day than the world is demanding to producing probably 2.5 million barrels more than the world is demanding, probably by June of this year. So oil prices, and a lot of that oil is winding up in storage. We're running out of storage space. Oil prices are likely to retest their lows, which were around $40 a barrel at some point earlier this year. The last point on oil, and I hate to spend that much time on it, but is people wonder, well, is it good or bad for the U.S. economy? And we use more oil than we produce. We still import oil in the United States, so we use more than we produce. So lower oil prices are a good thing. Now here in California, we caught a big break on gas prices. Then we had the refinery explosion in Torrance, and then we got the switch to the summer grades, and prices have jumped back up, but they're still lower today than they were a year ago. And the thing about lower gasoline prices is, yes, we may save $700 to $800 a household over the course of a year, but we don't get a check up front. Nobody sends us $700 and says, here's your savings on gasoline. You save a little bit each week. And because the savings are incremental, the negative impacts from the cuts in oil production across the country, mainly in Texas, Oklahoma, North Dakota, Colorado, New Mexico, as the top 5 oil-producing states, the cuts that we've seen in oil production have more than offset the positive benefits from gasoline prices. But as the year progresses, the drag from the cuts will be mostly at the start of the year. We'll benefit from lower gasoline prices over the course of the year. There is one industry that has benefited almost immediately, and that's the restaurant industry. And we've seen that nationally, restaurant sales are up 13% year to year. Really the only place that we see double-digit growth, whereas sales at gasoline stations, because of the lower prices, are down 23% year to year. We get updated data on those stats this week, but it makes sense to me. And if you save 10 to 15 bucks on filling up your car or SUV, then that's about what you would. That'd be about just about enough money to make going out to a restaurant a little bit more attractive. The third question we get a lot on is interest rates. And typically, up until recently, up until the stronger jobs numbers, the questions always have been, why on earth would the Fed ever think about raising interest rates? And my answer to that is because they're at zero. It's there's only one place to go, and zero is not normal. It's lower than it's been at any time in U.S. history. We've got lower short-term rates than we did during the Depression, during any of the wars that we've been through. The Bank of England has lower interest rates in place today than any time going all the way back to the 1600s. And that included the aftermath of the South Sea bubble, bursting of the South Sea bubble. Rates are extraordinarily low. When the Federal Reserve took interest rates to zero, it really did look like the sky was falling. And interest rates are still priced as if we're in the throes of the financial crisis, and we're not. We're nearly 6 years past it. And we haven't gotten back everything that we've lost, and I don't know that we will. And quite frankly, I don't think we're going back to where we were before when people were flipping houses all over the place. We're going someplace else. And so not everybody's going to get back to where they were previously. But the economy is in a far better place today, and the Federal Reserve needs to begin to think about normalizing interest rates. Well, because we're further along than the rest of the world, particularly Europe, we've seen that the dollar has strengthened tremendously, and that's one of the things that's unnerving the stock market. And a lot of folks are saying there's no way the Fed can raise interest rates because the dollar is so strong and it'll just strengthen further. That actually is not correct. And a lot of people feel that exchange rates are driven by interest rate differentials. And that simply is not the case. They're driven by the differences in the risk-adjusted rate of return on investing in one country relative to another. And interest rates are one of the best and one of the easiest to see approximations of those risk-adjusted rate of returns. And right now, the risk-adjusted rate of return on investing in the U.S. looks really good relative to Europe. It looks really good relative to China or relative to Latin America. And so the dollar's strengthening. The Fed hasn't raised interest rates yet, and the dollar has strengthened. So I don't think that the strength in the dollar is any reason for them not to raise interest rates. That strengthening in the dollar is going to occur, quite frankly, whether they raise rates in June or September or wait until 2016. We think they're going to go in June. The fourth question mark is on housing. And housing has been a bit of a mystery. There's been one area in the housing market that has recovered relatively well, and that's been apartments. Last year, nationally, we started 1,005,000, there were housing starts totaled 1,005,000 homes. Of that, a record proportion were apartments. And it seems like they were all for wealthy millennials that wanted to live in downtown San Diego or live right next to a metro stop. Or it's transportation-oriented development for the most part. Downtown areas have seen a tremendous growth in apartments. It hasn't all been there, but it's very visible when you go to a downtown area, and you can go to just about any downtown area in the country, and you'll see apartments are being built in those downtown areas. And there's a story that young people, that millennials saw their parents get burned by owning homes. And so they're soured on home ownership, and they're not going to buy homes. And I don't think that's the case. I think that millennials are just young, and young people rent apartments. I mean, that fits in with their lifestyle. And when millennials get older and they get married and have babies, they will buy houses. And we're already seeing that the leading edge of the millennials, I believe, is 36, is the oldest millennial turns 36 this year. So the millennials make up the bulk of what would be the prime first-time home buyers. And as we're seeing more and more get married, and they have delayed marriage. The recession caused that. People delayed marriage and they delayed having babies. They actually delay, if you look at the average age that women have their first child and the average age that they get married for the first time. Gosh, I can't believe that I just said that, married for the first time. But it's, but I guess that's not as dramatic as the stat here. But women actually, on average, have their first child before they get married for the first time. So it is the two had been very close for quite some time. That's just and I'm pretty sure that's averages and not medians. And it's been lengthening because, and the recession caused that to lengthen considerably. So if people delay those lifestyle events, we're going to see that home ownership gets pushed down a little bit, so it's not all that surprising. This year, though, we're expecting some big things out of the single-family market. One of the reasons why housing has been so slow to recover is that the job market has taken so long to recover, and last year was really good. And household formations tend to move in line with employment. And for the first 4 years of this economic recovery, we added about 2.7 million people to the U.S. population each year, which is a little bit lower than our norm. Historically, it's been between 2.7 and 2.9, so we're right at the lower end of that boundary. But that 2.7 million new people only generated 550,000 new households because people were staying in school longer, they were living with their parents longer. Heck, they were even staying married longer. You know, people were afraid to go out on their own. Well, with the job market strengthening, we saw that household formations increased from 550,000 previously up to 1.2 million in 2014. And the household formation number is not the most precise thing in the world, but you can get to it 3 or 4 different ways. And we did that. We back tested it in a number of different ways because it was such a change from what we'd seen previously. And we also said, well, you know, I always tell people economics is just common sense made difficult. That's all it is. It really is not all that. It's just, and I said, if last year we delivered 850,000 homes, apartments, townhomes, condominiums. In total, we delivered 850,000. If we had demand for 1.2 million new units, then the number of vacant units for sale and vacant units for rent should have declined. And sure enough, it did decline. I mean, there's one other variable in there, which are removals from stock, which are very hard to track. But the vacancy rates for homes for rent, homes and apartments for rent, vacancy rates for homes for sale are the lowest they've been since 1997, which was before the housing boom got started. So the table's set this year with job growth having picked up as much as it has and continuing to pick up, and even the 3 lagging areas, financial services, other services, and government, are now adding jobs at a solid pace. We're expecting 1.5 million new households to be formed in the United States. And that's a phenomenal number, and we're only expecting about 1,100,000 homes, apartments, townhomes, condominiums to be completed this year. So supply is going to get tighter, and what you hear more and more from builders and realtors is what's holding back home sales more and more is the lack of supply. And I think in that kind of environment, prices are probably going to remain firmer. We've seen that price increases have been moderating as investors pull back from the market. I don't think they're going to moderate as much as we thought previously because supplies are going to be tight. The last point that I have on here is just how sluggish is the global economy and what's it going to take to get Europe, Japan, and China back on track. 3 very different stories. Japan actually, their economy seems to have firmed a little bit and seems to be doing a little bit better. I think that the strengthening in the dollar has helped them, or the weaker yen is helping them. Europe's economy also seems to be doing a little bit better in terms of GDP growth, not so much in terms of employment growth. They have issues surrounding Greece and the Eurozone in general that still need to be resolved. In a good year, Europe's economy will grow about 2%. We think that they'll grow between 1.5% and 2% in the second half of the year. China's economy is decelerating, and China has been the fastest growing market for most states and many companies in the U.S. And they have the attitudes in China have changed in a major way that I don't think. The attitudes about the Chinese economy have changed in a major way that I don't think has been fully appreciated. In China, their own views on what kind of economic growth they should pursue have changed from any kind of growth will do to we want to de-emphasize growth in low-paying industries, in industries that really pollute the environment in outrageous ways. And those were changes that had to be made. If you've ever been to China, I remember my first visit to China, I was staying at the at the Hilton right in Hong Kong. I was staying in Hilton right on the harbor. You couldn't see the water. I mean, the air was that thick. And then we went to Shenzhen, and you couldn't see your hand if it was this far in front of your face. I don't know how we drove. I didn't drive, but I don't know how anybody drove us. But that had to change. The other thing that's changed, though, is on foreign investors' end, on our end, in that the China strategy used to be, we need to move as much production over to China as quickly as possible so that we can cut our cost and be hyper-competitive. Well, a lot of people did that, and then they found out that, wow, we don't have the protections on our intellectual property, which is real important for firms in Southern California, which have a lot of intellectual property. And now folks are saying if there's any sort of production that involves a high degree of intellectual property that we want to protect, we don't want it to go to China. We're going to keep it here in the United States, or we're moving it back to the United States, and we'll move older technologies to China. Well, the net result of that, I think, is that China's economy is going to slow much more than people currently expect. I think the IMF's forecast for China is 6.8% growth this year. I think we're a little bit slower at 6.5%. But by the end of the decade, China's economy is going to be growing somewhere in the 3 to 4% range on an annual basis. Some of that is due to the base effect, and that the base has gotten larger. Some of it's also to demographics. The demographics of China are much more advanced than people realize. Shanghai is the oldest city in the world. By the end of the decade, the demographics in China are going to more closely resemble those in Japan. So there are a number of factors that are slowing China's growth. It is a bit of a game changer. But my point in raising that is a lot of people think, oh, what we really need to happen to get the U.S. economy firing on all cylinders again is for Europe's economy to grow and China's economy to pick back up. And I think that what's happening in China right now is a lot more secular than cyclical. And so the slowdown there is a lot more long-lasting. So I wouldn't count on a big pickup there. I'm going to go through some charts real quick just to put some pictures behind this, because it's always good to see the visuals. In terms of GDP growth, it's not the most exciting chart in the world. Our forecast for first quarter GDP, and we're nearly finished with that, and we're 10 days into March. Our forecast for first quarter GDP is just 1.1% GDP growth. And a lot of that is due to the widening in the trade deficit. Some of that is tied to the strengthening of the dollar. And a lot of that is tied to the strengthening of the dollar. Some of that's also tied to the plunge in oil prices. And the plunge in oil prices is due to weaker demand for petroleum products in Latin America. Plunge in petroleum prices. Along with the plunge in petroleum prices, we've seen our fastest growing exports in the U.S. were diesel and jet fuel, petrochemicals, and oil service equipment. It had made Texas the #1 exporter in the United States. Texas surpassed California. All of the exports of all of those items have slowed in recent months. In terms of job growth, you look at on your left here, you can see the gains in non-farm employment, the 295,000. You can see how much it has picked up in recent months. The unemployment rate's come down to 5.5%, which is in the zone of full employment. And what full employment means is that everybody who wants a job and is capable of doing the job that they want to do and lives in an area where that job is, has one. Unfortunately, we have a lot of geographic immobility in the United States, which is something that we usually didn't have to deal with. But with the housing collapse, there are a lot of people that are married to their homes and are stuck in one part of the country but would like to be working in another part of the country. That situation has gotten better, but that's one of the reasons why underemployment has been as high as it is because people say, I can't afford to sell my house, so I'm willing to take a job at a lower level in order just to keep making the mortgage payments and hope and wait till things get better. Good news is that if you look at some of the measures of underemployment, those numbers have come down. They expanded the U6 measure of the unemployment rate. It fell from 11.3 to 11 in February. You can see that's the top rate on these charts relative to the headline unemployment rate, which is 5.5%. It's been falling faster than the overall unemployment rate. I'd mentioned earlier that if you break out employment between part-time and full-time employment, that part-time employment has accounted for a disproportionate share of job growth in recent years. And this chart breaks that out fairly well. You can see the, unfortunately, I think these are January's numbers, so they don't have the February numbers. And in February, we had, for full-time employment, was 900,000 jobs below where it was prior to the recession. You know, the lack of full-time jobs is one of the reasons why housing has been so slow to recover. You have to have a full-time job in order to buy a house. It also explains a little bit as to why folks have not been so eager to go out there and spend the savings on gasoline. If you don't drive to work each day, then you probably aren't saving a whole lot of money on gasoline. You have to drive in order to save money on gas. And if you're sitting at home and you're flipping between Jerry Springer and Dr. Phil, you're not going to save any money on gas. And if you look at the total number of miles driven in the United States, which we track, it is very close to where it was just prior to the recession. So go back to, from the latest data as we have is from November. They don't seasonally adjust these numbers. So if you go from November of 2014 to November of 2007, the numbers are roughly equivalent, a total number of miles driven. Fuel economy has improved dramatically over that time period. We had cash for clunkers where people traded up and they had to improve fuel economy in order to qualify for the benefit. Not going to go through all these charts, but there's, suffice it to say, we got tons of charts dealing with employment in there because that's been one of the key areas of concern. I did want to point one thing out on oil prices. I'd mentioned that oil production has increased dramatically over the last 3 years. You look at production of oil here, this is millions of barrels per day, and you see that parabolic rise in oil production. That is a real clue that there's been a technological shift. I think that, you know, I could show you the same chart on proved oil reserves in the United States. They've risen from 20 billion barrels to 35 billion barrels over the last 5 years. And prior to that, they'd been declining for 20 years. So actually, been declining for 30 years. And so the amount of oil that we know that we have in the ground is much greater than it was previously. Those changes have been brought about by advances in technology. In terms of interest rates, don't want to belabor the point. There's just one chart that I wanted to show you here, which is if you take the average of interest rates in Germany, Japan, and the UK and compare those to U.S. rates, you can see how big of a factor they have been in pulling down U.S. rates. And actually, the gap between the 10-year Treasury and the 10-year German Bund has never been as wide as it is today. So we do think rates will rise a little further in the U.S., but I don't think that they will rise that dramatically because rates in Europe and elsewhere are so much lower. I'm going to skip ahead and get to the California slides. In terms of regional economic growth, it's interesting to look and see where the strongest growth has been in the country. There are two areas that have really stood out. One has been the energy states, Texas, North Dakota, Oklahoma, Colorado, New Mexico. Those 5 states have accounted for about 30% of U.S. GDP growth since the recession ended. Now, when prices began to slow, we put out a report on Texas, and we put out a couple reports on Texas. We think that their growth will slow to about half of what it was previously. There's probably risk to the downside on that. The other area that really stands out, the Pacific Northwest and the coast of California. If we could break the data out on the MSAs, you would see that the Bay Area and Southern California are some of the fastest growing areas in the country in terms of income. Really, the Bay Area and San Diego and Orange County are some of the fastest growing areas in the country in terms of income growth. And the other area that's really turned around has been Florida and Georgia, which were 2 areas that were decimated by the housing bust and have seen everything tied to housing turn back around in a big way. In terms of job growth, I have California's old numbers here. The new numbers came out on Friday. The new local numbers are supposed to come out this morning. And in terms of job growth, the previous numbers had shown that California had added about 340,000 jobs year to year, December to December. That number was revised up to about 480,000. We have these revisions each year. They come out in late February, early March. And The revisions are based on hard data as opposed to the survey data. And what we saw in those upward revisions were not only was job growth stronger, but it was more broadly based than had previously been reported. In terms of the unemployment rate, we're at 6.9% now in California relative to the 5.5% rate nationally, although there's a month difference between those two. California's unemployment rate has consistently been higher than the nation's unemployment rate ever since the Berlin Wall came down. And you'll see that they go all the way back to 1990 is what we have on there, so you don't need to go all the way back to 89, but we've been higher. Even throughout the tech booms that we've had, California's rate has been higher than the nation's because we lost so many of those defense manufacturing jobs. And those defense manufacturing jobs, they were mid-skilled manufacturing positions, which really we haven't been able to replace with like-kind jobs. In terms of port activity, the West Coast port slowdown received considerable attention, and for good reason. It's been an important driver in Southern California, particularly in the Inland Empire. It's got a lot of add-ons in the Inland Empire. It's interesting that the port slowdown, I mean, we had the lockout in February, but even before then, we had seen that activity had slowed at the port. Through all of that, if you look at the total volume of containers going through the port, it was up 6% last year. So even though activity had slowed, it grew. Now, it definitely fell in February. We don't have numbers for February yet, but it's definitely will have fallen off in February and probably fell in January as well. But the volume, even though the volume of international trade has slowed along with the global economy, activity at the ports here in California has continued. Southern California has continued to grow, and if you threw in Oakland on there, which is another big port, you'd see the growth was even a little bit more significant than that. I'd mentioned that housing has had a tough time getting on track. We have seen that we've had a couple of rounds of existing home sales where there's been some strength in existing home prices, where there'd been some strength, where we had investor buyers coming in. Those investor buyers have largely exhausted the supply of distressed properties. There's really not a whole lot of distressed properties overhanging on the market. So I'm going to fast forward here to just the metro areas here and looking around at the state. Job growth in California is extremely broad-based. Every major metropolitan area is growing. You want to be in that top right-hand quadrant, which means that not only is job growth up on a year-to-year basis, but it's growing at an accelerating rate. And you can see that the largest bubbles that are, I hate to use that word bubble, the largest markets that are in that right-hand quadrant are San Jose, San Francisco, and San Diego. I mean, they're the ones that are furthest out to the right. These numbers are on the previous data with the revisions having been so strong for the state. I have got to believe that San Diego would see a large upward revision, and the numbers would be even stronger than what we have reported today. When you look around and see where job growth has been and which industries have added the most jobs, professional and business services and construction, that's professional and business services is where you have most of the high-tech jobs are going to be found in professional and business services. The areas that have been lagging, financial services, government, and other services, with the revised statistics that came out on Friday, all of those are positive in the top right-hand quadrant with about 2% growth or better on a year-to-year basis, growing faster than the national average. I'm going to run out of time here because I want to make sure that we have time to move on with the program. But in terms of, I'm going to hand it off in just a second. But I wanted to talk about what's happening in the technology sector in California. This technology boom that we've had has been much more centered around information technologies. It's been centered around communications technologies. It's much more centered around intellectual capital than around physical capital. And if you look at the manufacturing of tech products, virtually all of them have declined on a year-to-year basis. Employment in the manufacture of tech products has declined over the last year, and it's declined over the course of the business cycle. That's been most acute in communications technology. Even though this this expansion has been driven by the growth in handheld devices and social media and everything that goes. It's been a communications-driven recovery. It hasn't been a communications manufacturing-driven in recovery. It's been the technology behind the equipment that's been driving it. It's also the fastest growth has been in pharmaceutical manufacturing, and that's been the one area that that's truly boomed in the economy. It goes with the aging demographics of the country. It's also the area that I don't have it on there. It's also the one area that where folks have raised some issues about maybe there've been some speculative excesses. The stock prices of life science companies are trading at some pretty high multiples. There's been a lot of questions raised about whether or not we're in the midst of another tech bubble. I think merely because the NASDAQ came up to 5,000 again, and people are revisiting that level. There's one key difference between the NASDAQ at current levels and where we were previously, and that is PE ratios. Back in 2000, there was no E, so the PE ratios were stratospheric. Today, if you look at price earnings valuations in the tech sector on the NASDAQ, they look reasonable. They look close to their long-term norms. If you look in life sciences, it's a little different. The valuations are pretty high, but where you really see if things are bubbly, it's in the private equity side of the market and the private equity valuations. But when you look at the growth in venture capital, in an absolute sense, it really is. It's not as high. It's not as large as it was in the 90s. It's just that the valuations that are being paid for the first movers, the Ubers of the world, are just stratospheric. And so there may be a bit of froth in certain parts of the market, but it seems, if there is froth today, it seems to be much more narrowly focused than it's been in the past. The last charts deal with job growth here in Southern California, and you look at San Diego down there in terms of job growth on a year-to-year basis. These are December to December numbers, 3.3%, strongest growth in Southern California. And however strong that was, I am fairly certain that the revised data that we're going to get later this morning will show that those numbers are even stronger than that. I think that the numbers will be well to the north of that. So let me stop there, and so that we can stay as close to being on time as possible. And thank you very much for your attention. We're going to both take questions at the tail end.